Rob Luna is CEO and Chief Investment Strategist at SureWest, a CI financial company. He joins us live from Los Angeles with his thoughts on the markets. And Rob, I was going through your notes, just the guy to talk about chips this morning. You think it's a good entry point to get into NVIDIA. I was looking at the semiconductor index, and we're talking about the chip winter extending out. It's been pretty down, not out, according to you?
Yeah, I mean, I guess that's where the money is made, though, right, is buying into pessimism and selling optimism. When you look at a company best in breed like NVIDIA, I mean, it's absolutely out of favor right now. But I think if you look at where the stock was 1 year ago, it's down 50%. And I think if you take a little bit of a longer term perspective, and I think that's absolutely what you have to do in a market like this, where we're headline driven, numbers like CPI coming out tomorrow are going to be hugely important for some of the names like semiconductors in particular. I don't necessarily know that you go all in right here, but I think especially if you don't have a position in a name like NVIDIA, I think this is a good point. I'd rather be telling people get in when it's down to 50% than at all-time highs, like a lot of analysts were tripping over themselves to upgrade a year ago.
So your argument is more valuation than what's happening structurally with these businesses, where they're admitting that there is a slowdown in demand. And so what do you do about that? What's your outlook on that?
Yeah, I mean, I think demand is temporary, though. And I look, when you're comparing from a period of time like COVID, when everybody was in home, everybody was in gaming, everybody was trying to get their hands on as much as they can, obviously you'd see some type of a slowdown. But when you look at the Internet things and pretty much everything in our life at some point in time having a chip in it, I think the macro picture, the secular theme for semiconductors, where I used to be a trader of semis, I think in your portfolio, you should think of it with a little bit of a longer term structural position.
And that's exactly what I was going to ask, Rob. In so much as you can be investing in the chip stocks right now, obviously there is not only the risk when it comes to demand, but you're also looking at potentially a glut of supply moving forward, considering everyone's really ramping up at the same time. So if you're an investor watching right now, you're saying, don't worry about the next 12 months, but think about investing in NVIDIA, investing in AMD over, say, a 5-month or 5-year horizon, rather.
Yeah, and I think, and I do say names like NVIDIA, AMD, I think you can look at also, not names like Intel, that if you take a look at PC demand, that's dying, and they unfortunately haven't really been able to adapt to that, where I think NVIDIA has. And look, we all know it's all about pricing. And so when we think about all this negative information, all of which you're bringing up is very valid, the stock has been cut in half. So it's not like there hasn't been some risk taken out of it. And as I mentioned, I think you used to have to trade semiconductors, but now the position that they hold in society is so important, so fundamental, that I do think for investors, if you could think a little longer term, this could be a good entry point.
I'd suggest people still do trade when it comes to the SOX index, especially on the inverse leverage front. But I wanted to touch on some of your notes when it came to what millennials and what they're doing with their money, because you mentioned Airbnb and you mentioned RCL. So for anyone watching, that's Royal Caribbean. Now, I suppose it's a little bit of a double part question, but I look at Airbnb and I think to myself, okay, if there is going to be a recession in the United States, are people going to travel? Are young people going to travel? And then what does that do for their bookings? And then for Royal Caribbean, is that more of a play hoping that they're going to capture more of the luxury and premium market, considering the next 12 months might be tough as well?
Yeah, it's a great question, and I think you've kind of hit on it there. Well, first of all, for those who don't know, the millennial generation, late 20s, early 30s, it is the largest generation in American history. And if you look at the age demographics, that's really where purchasing power is going. And if you look at all these companies, they're really obviously trying to capture that. And so when you look at Airbnb and you talk about a recession and a slowdown, one thing is somebody who works with a lot of millennials, and particularly wealthy millennials, they much rather would spend on experiences, sometimes to their detriment, than they would assets like you would see from the baby boomer generation. So I think, and I've seen, they will continue to spend there. Also, let's remember that COVID has actually kind of reshuffled the workforce, where a lot of people today can still work remotely. I've seen people using Airbnbs as a way to kind of have a traveling and roaming office. And you hit it on the head with Royal Caribbean. The reason not Carnival is because they are a celebrity, and some of their brands really catering towards that higher end crowd and some of those higher end themes that, again, millennials are really shifting to. So I think out of all the cruise lines, that one being beaten up a lot, but also more importantly, again, back to thinking out a year or 2 years, they really kind of get the theme of where the millennials are going.
Right. Rob, I just want to circle back to the whole chip story and wonder whether in your portfolio you would look at the likes of TSMC and Samsung as well, because Morgan Stanley just put out a note saying the material subsidization could have a material impact, actually, for some of the companies outside of the U.S. And these two are the majors there, right?
Yeah, I think so. You know, right now I can only talk about what we're spending our money on, what we're investing on. I think NVIDIA is really the play. I think if you're not going to look stock specific, I'd much rather just buy a basket, buy an ETF. But I really think NVIDIA is the company that's gotten it right, got it in gaming, it's got it in automobiles, and I think they're really going to be the long-term benefactor. And as we've seen, I mean, there's going to be some companies like Intel that just aren't going to participate. I really like NVIDIA, and again, with the stock being down 50% in the last year, longer term theme, that's where we're putting our clients' money. That's where I'm putting my own personal money.
Let's take it back to the start just to finish off. You mentioned inflation and the impact that we could get.
Yeah.
We could see some upside, we could see some downside when it does come to that read. But realistically, when it's running 8%, when it's running 7%, when in all likelihood you're probably going to see 6% by the end of May 2023, do you think the Fed can stop?
Well, look, I think at the end of the day, most people in the narrative is that the Fed's always gotten it wrong in the past, and so they're going to get it wrong now. And I don't necessarily know that that's the case. And let's, think about what is inflation going to do? How is that going to really impact the economy? Well, the 10-year bond, obviously, the risk-free rate in which everything is based off of has increased. So mortgage rates are increasing. The hurdle that you have to have from equities is increasing. But that doesn't mean, and I don't think the underlying economy is as weak as most people think it's going to be. It doesn't mean we could have that 10-year rise. And if we get a strong kind of Goldilocks type of economy, that the market can't continue to chug higher. Let's remember, the market was up in the 90s, almost 500% during that period of time. The average 10-year bond was at 6%. So just because we haven't seen those rates in a long time doesn't believe that companies aren't going to be able to innovate, aren't going to be able to have purchasing power. But look, also, when you think about inflation, the supply chain in just about everything has been shut down. Demand significantly increased. The velocity of money, the U.S. put money right into the hands of consumers, unlike 08, 09, where the banks kept it in their coffers. That was a perfect recipe. I think the Fed is getting a bad rap. I think you're going to start to see numbers slow down a little bit. But the market where it's at today, right below the 200-day, no one's going to trade this thing higher until we see that print tomorrow.
Okay, Rob, I agree with a lot of what you're saying, but if you think about what or who is trading right now, it's a lot of algo, it's a lot of insto. When you see the case made that when you look at the 10-year paper right now, let's call it sitting at around about 2.8%. If you see the Fed having to go aggressively, it's going to pop up. And then because there just isn't the other investment coming in, and it's going to be a lot of algo trading, a leg down is almost certain.
Well, I mean, it's certain unless that number comes in softer than expected tomorrow, and then we could rally above the 200. And let's remember, the last two times the Fed has been raising short-term rates, but we were at 3.3, 3.4 not too long ago on a 10-year. So it doesn't necessarily mean that we're going to see short-term rates increase and long-term rates increase simultaneously. And we're in one situation right now where it's interesting. I said the next leg down in stocks would be because of interest rates, which means bonds and stocks would go down. But now the same catalyst that you need for equities to rally, you also need for bonds to rally. So it's going to be interesting. To your point, algos play such a large role. You could almost know for certain where it's going. If tomorrow you see something light on inflation and it reinforces that dovishness we saw out of the Fed, I think you could potentially break above that 200-day. And the narrative is we're going to go down. Everybody's positioning themselves on the short side, and we know when everybody's on one side of the boat, you probably want to step to the other side.
Be a contrarian, Rob. Lovely to have you in the show. Thanks very much for staying up for this interview. And Will, thank you very much for participating in this conversation as well.